Hi there YouTube, it is Monday the 2nd of October and that means it's time to take a look at what moved the markets last week. Last week saw the final trading week of September, and the more superstitious investors will be happy that this statistically worst month in the year is over, hoping for better times now that we're in the final quarter of the year. In the chart on screen you can see that the NASDAQ100 and the SP500 very strangely have the same more or less performance for the month, both ended the month nearly 5% down. Before I move on to macro events that had an influence on the market last week, I also wanted to look at some stuff that's more portfolio related, as well as some bellwethers in the market. For those of you that watch my videos, you know that I have been accumulating 7 to 10 year treasury bonds via the iShares ETF on eToro. I have a more detailed video that I posted some time back that talks about why bond ETFs are so good, especially in the current environment. I'll put the link up in the top right of the video so you can check it out if you want to. But last week I started adding a different duration of bond ETF to the portfolio just because the coupons on those bonds are so good. You can think of coupons as interest on a loan or dividends if you want. The different duration that I've been adding are the iShares 1 to 3 year treasury bonds. And I know that for a lot of investors, bonds are incredibly boring and also a little bit mysterious. So let me lay it down for you. This particular ETF holds a combination of treasury bonds, so US government bonds issued by the US government. They are of the 1 to 3 year duration, so they mature over 1 to 3 years. If you were able to hold these bonds to maturity, the average yield right now would be 5.1%. So for every year that you hold them, you would receive 5.1% of the total amount that you had invested into this particular ETF. Another benefit of a bond ETF, or this particular bond ETF, is that the distribution frequency is monthly. So they pay you 1/12 of that amount every month based on however much you'd invested. Why do I like bond ETFs so much at the moment? Well, the market is trying to figure out which way it's going to go. Macro data, there are patches of it that are positive, patches of it that are negative. And instead of holding cash at the moment, why not put my money into bonds, which are giving me a return on that cash while I wait for a more clear signal that the market wants to rev back up once again. But wait, that's only the first benefit. So if you were to put, let's say, £1,000 into the iShares 1 to 3 year treasury bond ETF and it continues to return 5% per annum, then you're making 50 quid on top of the £1,000 that you'd put in there. If the US government decides to increase the interest rate, then this yield will go up, giving you a higher return on that investment. But what about if the opposite were to happen? Well, that's the nice thing about holding bonds and bond ETFs. I have two lines on screen. The candles represent the prices of SHY, the ETF that we were just looking at. So you can see that this has been steadily dropping since May. And I've overlaid this with this orange line, which is the yield of the 1 year treasury bond. And as is incredibly obvious from what you can see on screen, the yield of a bond has an inverse relationship to the price of that bond. What this means is that while you are accumulating these bonds and being paid a dividend, a coupon, for the amount of money that you're lending to the US government, when the yields do fall, and they will fall eventually, the price of this particular ETF is going to rise. Now, there is a risk in investing in bonds. Bonds are loans, and so if you lend someone money, there's always a risk that that entity is going to default. But we're talking about the US government here, so the risk is so low that there almost is no risk. Long story short, I like treasury bond ETFs right now because I'm being paid a dividend to put money into them. And when the yield does fall, the money that I've invested into these will also rise, and I'll be able to sell my positions in those bond ETFs, hopefully making a profit on top of that too. All right, moving on from bonds and bond ETFs. Earnings season did begin last week. It always begins, for me at least, with Micron, who reported earnings on Wednesday. Micron tends to lead the whole of the pack in terms of earnings season. Micron is a company that makes semiconductors. They are one of 2 companies in the world that make the kind of semiconductors that they do, a large portion of those being memory chips. And the fortunes of this business are closely tied to the economic cycle. So it's always interesting to follow Micron, and it gives you a bit of a hint as to where you are in the cycle and potentially where we will be in the cycle over the next few quarters. Just something to bear in mind though is that there is a challenge around Micron right now that's quite political because China has flagged them as a security risk, and a large part of Micron's products previously did go to China. However, putting that to one side for the moment, Micron reported earnings. They are reporting a loss at the moment. Truth be told, their earnings were a bit of a nothing burger. They more or less said what everyone expected. And analysts at the moment are trying to figure out if Micron is lowballing expectations so that they can outperform when they report earnings later on in the year. The fact that analysts are so divided here reinforces the fact that stocks right now are still looking for a direction. Things aren't so bad that everyone's calling a bear market. Things aren't so good that everyone's calling a bull market. It's more or less a wait and see kind of situation. We also saw a lot of very interesting macroeconomic data last week. Some examples include US GDP is still relatively strong, so 2.1% there, but as expected. Pending home sales coming in very weak, so the interest rates are really starting to bite in the housing and mortgage market. GDP in the UK came in a hell of a lot stronger than expected, and now they're looking retrospectively and think that they made a mistake, and the UK economy was quite strong through the pandemic actually. And then probably the most important data out of central banks and governments last week was the CPI number, inflation number out of the EU region, came in a touch lighter than was expected. And the core PCE, and I don't have it on here, but also the PCE price index number coming in lighter than the market was expecting. I put out a quick post on Friday last week saying that this is good news in a sense, but also if inflation were to stay above the target of 2%, let's say it stays at 3% for the next 10 years, that means that anything that you might pay $100, pounds, or euros for today would cost 34.39% more 10 years from today. And if central banks were to hit their target of 2%, then over the same kind of period, inflation at those levels would drive that item or service that costs $100 to increase by 21.9%. So even just a 1% difference in the rate of inflation over a long period of time can have an extreme impact. Just for interest's sake, I found this quite interesting. So even if inflation does sit at the 2% level, let's say for 100 years, you can see that inflation really is the thief of value. And I really like this chart too. So your buying power is reduced enormously at that inflation rate, average inflation rate of 2%. So your $100 today, 100 years from now, would only be worth 13.8% because of inflation. Inflation can be devastating because it does compound. The other big news last week was the potential for a government shutdown in the United States. You can read a bit about what shutdowns are here. Effectively, there is no funding agreed to run the various branches of the government in the US, which enormously impacts productivity in not just in the government branches, but across the whole country. Thankfully, like they always do, they've secured a deal at the last minute, although this will only leave them limping, I think, through to November. Even though this is always resolved, eventually the market does respond quite strongly, and I believe that part of what we saw last week was because of this fear. Looking now to what's going on this week, well, China is closed for holiday, for their National Day holiday, which ironically runs for more than one day. There'll be lots of PMI data coming out of the US this week, which is interesting because it gives us the opinions from people on the floor in various industries. But I suspect that the most closely watched data will be all of this data around employment. So non-farm employment change, JOLTS data, non-farm payrolls, and the unemployment rate, and initial jobless claims too. So quite heavy in terms of labor data. The reason that this is important, I've spoken about this many times before, is that the US Fed wants to see a slowdown in employment because that is a signal that their fight against inflation is working indirectly. And what we can see here is that non-farm payrolls, which measures the change in the number of people employed during the previous month, has been declining slowly and bumpily, but definitely declining. In a similar vein, if we look at the US unemployment rate, we can see that it bottomed out roughly in Q1, Q2 of this year and is seemingly ticking up now. The fear here is that the Fed has been so strong-handed that they're going to drive unemployment up quite significantly, meaning that we will see a recession in the US. All right, that's it for this week. I hope you have a good one. Speak to you soon. Goodbye.